That's right. It's real. I'm not making this up. I bought Crocs, the shoe company, the goofy looking TikTok shoe company. I added it to the portfolio this morning and I bought $2,000 of it. So it's not a massive position, but this is one that I am excited about to have it in the portfolio here. And I think that although you might not take this company seriously because it's not Nike, it's not Lululemon, it's not one of these top tier premium brands, I think Crocs is better value. I think it has more upside. I think this company and the stock could potentially double in size. And I want to go over it with the fundamentals. We'll be looking at the balance sheet, the growth figures, the valuation of it, the historical trends, and some important news, which is their acquisition of the company called Hey Dude. We're going to be looking at all of this because during a time when everybody else is doing their prognostications on the future of the stock market, talking about macroeconomics and inflation, I like to take a step back and focus on fundamental research of companies because I think that's where you can actually make money. When everyone else is talking about the stock market and maybe it will go up, maybe it will go down, that's when we should be looking at individual companies and trying to find really good value while other people are distracted. So in this video, we're going to be going over Crocs and my investment thesis on it, the bull case and the bear case, and why I ultimately decided to add this one to the portfolio. So let's go ahead and jump right in. This is the story fund. This is my growth portfolio. I started it in 2021. It went down with the QQQ and the rest of these growth tech companies. And since then, I've been building back different holdings. I've been trimming different positions, adding to different positions, and trying to position this portfolio to bounce very strongly when the market eventually covers. Because I'm a firm believer, I'm optimistic that this market eventually will recover. It's just a matter of time. Now, in terms of recovering, in the past 30 days, the story fund is up $12,800, 14%. That beats out both the QQQ and the S&P 500. So this one did fall quite a bit from 2021 to 2022, but on these little uptrends, when the market actually turns bullish again, this thing bounces a lot. It really comes back strong. One of the companies that came back very strong last week was Amazon. It went up 10% in one day after earnings. This is a company that makes up the biggest portion of my portfolio. And just in the past 30 days, I'm up 8,600 on Amazon. Google also came back strong, 6% on that one. Netflix up 25%, right, in the past 30 days. We have Microsoft up 7%. Alibaba's the outlier here. It's down because there's renewed fears of China delisting and Jack Ma relinquishing power over Ant Financial to the Chinese government. Those are developments that I don't like to see. I have been disappointed with how Alibaba's worked out. Regardless, we have other companies that are doing well. We have Salesforce moving up, Adobe moving up 12%, Apple up 17%. Huge month for Apple. Berkshire Hathaway is a brand new holding. And then Crocs, already up 4% on this company, but it is highly volatile. So this one trades around very volatile. Now, what I do, and I've mentioned this before, is I'm trying to beat the S&P 500 from 2022 till the end of 2025. So I want to outperform it over a 5-year time horizon. This doesn't mean I'm going to outperform it over every single part of that time horizon. But at the end of 2025, I want my portfolio to have given superior gains than the S&P 500. And what I'm doing is I'm tracking this transparently every single week for everyone to follow along on the spreadsheet here, which is the time-weighted returns of the portfolio. The blue line is the story fund. So that's my portfolio. And then the red line is the S&P 500. You can see the big fall starting the beginning of 2022 in my portfolio as tech companies sold off more aggressively. Then we had some big hits with Alibaba, Netflix. Those are the two that hit us. There's other companies that we avoided like PayPal. I avoided the big fall down in Facebook. But we did get hit with Netflix and Alibaba. Now, the recovery has also been pretty strong. We're catching back up to the S&P 500, but right now the portfolio is down 14.54% time weighted. Then we have the S&P 500 up 4.87%. So even though you can see the gap closing here, we still have a ways to go. I still have a ways to go before we catch up and surpass the S&P 500. But that's the goal. I'll be tracking this till the end of 2025. Then we'll do a whole analysis on how it did, how we performed. And you get to follow along and see what trades I do in the meantime. Now, let's go into Crocs. Everybody knows this company. I don't have to explain it. You've seen the Crocs shoes. They are the plastic looking mold where the shoe is almost entirely one mold. The only thing that makes it two parts is that little strap on the back. That's it. The design is super simple. The company blew up on TikTok with Gen Z and different kids making video after video on how goofy Crocs are. They attach little things to Crocs to kind of stylize them. And they're kind of an ugly shoe. They don't look good at all, but they're almost so ugly that it turned to a positive thing. Like now people actually like the look of them. People are actually buying them. And the brand name Crocs, the actual Crocs brand, has become some sort of a household name. Their sales continue to surge. Even after 2021, they're still expecting the sales to surge. So this is quite the story of this company. They did all the right marketing during 2021. They made their brand this social brand on social media where everybody bought Crocs and stylized them, made goofy videos about them. But then they actually had real world applications. The shoes themselves are very comfortable. People do enjoy wearing them. They last a long time. They don't wear down easily, so they get good reviews. People like using them. And they're so simple to make. The molding's so easy compared to a complex Nike shoe that has different textures, different layers, different materials, that you can make Crocs for a much higher margin. They're easier to make, cheaper to make, and they sell them for roughly the same price as many other shoes. So the margins on them are incredibly good. And then on top of that, it's easy to stylize them. They have thousands and thousands of different styles and colors and variations, but it's all basically the same shoe. This is the story of Crocs. Now, I personally don't have any pairs of Crocs. I don't really wear them, but I do wear something called Hey Dude. These are the shoes that I wear, and I really like them. You can make fun of these ones as well because Hey Dudes are also very comfortable. They're not very professional. They're more like casual loafer shoes. But Crocs actually purchased this company called Hey Dude for $2.5 billion, and they announced this at the end of 2021. Now, this is the company Hey Dude. This is what Crocs bought in 2021. These shoes that are ultra light, they're extremely comfortable. If you haven't worn them before, I'm telling you, they are very comfortable. We can go to the Wally ones here. These are some of the ones that I like. Let's load them here. This is on Hey Dude's website, by the way, but we can look at them in a couple different places. This is what they look like. They're just very casual, comfortable shoes. A lot of people, I think, in like Texas and around the surrounding areas is where they get most of their sales. These ones are more popular with older generation, millennials and boomers. I don't see a ton of Gen Z wearing these. So Crocs actually did a bit of diversification here. The Crocs brand, I think, mostly appeals to Gen Z and younger folks, even though there's a lot of overlap here. There's lots of people with every age wearing Crocs shoes, but Hey Dude, I think, appeals a little bit more to the older folks, millennials and boomers. So we have an overlap where they actually diversified their product line, which I think will stabilize their sales a little bit more. And this is a brand that I think was a really good pickup for this company because there's a lot of cross-selling opportunity. The people that like Crocs will probably like Hey Dudes. The people that like Hey Dudes will probably like Crocs. So they can cross-sell these. And when I look at this company, Hey Dude, look at this on Amazon. I just searched Hey Dude men's shoes in Amazon. This is what it brings up. Check out the reviews here. This one right here, the men's Wally socks shoes, 50,000 reviews, 4.8 stars. 50,000. This one, women's Windy shoes, 78,000 reviews, 4.7 stars. 50,000 reviews. Let's see, 4.8 stars. 78,000 reviews, 4.7. 46,000 reviews, 4.8. These are all different listings. They have listing after listing after listing. Most of them have tens of thousands of reviews, and most of them are right there, all 5 stars filled in gold. That is really good to have this on Amazon. When people are searching for shoes and they see this many reviews with this high of ratings, makes it so much easier to purchase. And I think it deserves it. So if you've never heard of the brand Hey Dude, order a pair off Amazon. They have free returns. Try them out. They are the most comfortable shoes in the market, and I think they will continue rapid sales growth. Now, here's the interesting thing. When I look at the year-to-date chart, obviously, and I don't think this may have been the only factor, but obviously the market did not like the Hey Dude acquisition. Crocs is down 46% year-to-date, and that's roughly when they announced the acquisition. So investors were looking at this brand Crocs, which they like, and then they looked at the brand Hey Dude, and they thought, you know what? They're purchasing this brand for $2.5 billion, and we don't know what this brand is. It's different than Crocs, and we don't like it. We're selling out of it. I think that, in addition to other factors in the market, like potentially going into a recession, caused the Crocs brand, the Crocs stock, to sell down 46%. If we go back a little bit further, this company was trading at 180. Now it's trading at 71. So it's sold down a lot over the past year. Now, I'm on the side where I like the HeyDude acquisition. I like HeyDude shoes. I think they're going to continue sales. I think they have a very loyal fan base, a following. I think people that purchase them will be repeat purchases over and over again. And I think with their cross-selling, they can grow that HeyDude brand and put it in different distribution. They can grow it over time. So I am happy with the HeyDude acquisition. I'm not on the side of the general market here where I think the company should be down 46%. So as of right now, that's the story of Crocs so far. The company blew up in 2021. The company acquired HeyDude for $2.5 billion. And then since then, the stock has sold down 46% as there's been concerns about the acquisition, and there's been concerns about the overall market trends, whether or not they can continue sales or whether it was a temporary fad. Now, let's go ahead and look at some of the fundamentals of this company and the valuation using Qualtrim Insights. This is a website available to all Patreon members. There's a link in the description if you want to use it. Now, before we jump into the fundamentals and the valuation of Crocs, my future outlook of it, I want to do a quick shout out for today's sponsor of this video, which is FTXUS. They are a large cryptocurrency exchange that has moved into other things like NFTs and stocks, and they have a new brokerage here. This is released out of beta, so you can use it today. And this is what it looks like. It's very slick. You have the dashboard here. I've been buying a little bit of Amazon. I bought it during the dip. So right now my Amazon position is in the green by $424. And you saw me do this. I've been showing every video. I bought a little bit of it when it was down close to $100 a share. And it's came back up a little bit. So I'm in the green on Amazon now. I'll continue to add to this one on a dip. You can buy fractional shares with this brokerage. It's part of FINRA and SIPC insured. And if you use the refer code Carlson, my last name, that will credit you $10 upon your first $100 trade. So sign up using the pinned comment in the link below. Use the refer code Carlson so they know that I sent you. And let me know what you think. So far, we've had good feedback. Now let's go ahead and look at the valuation and the fundamentals of Crocs, the reason that I'm buying this company. If we look at this here, we have it pulled up on Qualtrim Insights, which this website you're looking at is available as part of the Patreon membership. It's one of the many perks. What we have here is Crocs pulled up. Ticker symbol CROX if you're following along. The market cap is $4.41 billion. So this is a small company, by far the smallest in total market cap in the Story Fund. Most of the companies are $100 billion plus, even Amazon, which is above $1 trillion company. And this one's a $4.41 billion company. So it's basically a speck compared to something like Amazon. But regardless, I'll invest in companies of any size if I think there's ample upside, if I think I have the opportunity of doubling my money. If I look at this, the PE ratio is low. It's just objectively low for a company like this. The PE ratio on a forward-looking basis next year is 6.8. It's below 7. That is low. Let me do some comparisons here. We have Nike, far better company than Crocs. Quality-wise, longevity, brand image, right? This type of thing is far better than Crocs. I'm not making a comparison in terms of quality, but Nike trades at a 29 PE, almost 30. Crocs trades at a 6. We can look at Lulu here. Lulu's a company that's the new hot clothing company that's competing with Nike. They make the super high-priced, expensive stuff, and it trades at a premium valuation of a 32 forward PE ratio. So Nike and Lulu, they're trading at different stratospheres than Crocs right now. Crocs at a 6, Nike at a 30, Lulu at a 32. Even when we start to compare to more relatable companies to Crocs, let's say Skechers. This is a company that doesn't have some incredible brand image, right? It's Skechers shoes. They're pretty basic. Even this brand trades at a 13, which is more reasonable in this market. Nothing amazing. The S&P 500 is at like a 17. This brand trades at a 13. Then we have Crocs here. Crocs is trading at a 6.8. Investors are pricing in with Crocs a doomsday scenario. A huge drop in sales, a huge slowdown in revenue, a huge reversion to the mean with the company, even a recession that will hurt its sales. In every single metric, this company is far cheaper than any comparable company. Any of the clothing companies, any of the companies that are selling other shoes, especially when you start diving into the other metrics, the comparative relative valuation between this and other companies is pretty steep. The free cash flow yield of the company is 8.6. This is like the dividend yield, but for the amount of cash flow the company produces, 8.6. That's a high free cash flow yield for a company that's actually growing. We can again compare that to Nike here. Let's take a look at Nike's free cash flow yield, 2.4. So you see what you're getting with Crocs. You're getting a worse brand by far. It's not as popular of a brand, but it has metrics that I think are far superior in terms of valuation. The PE ratio of 6, the free cash flow yield of 8.6. Let's go ahead and look at some of the developments of this company now. If we were just to put a trend line in this, it would look something like this. The revenue was pretty flat for about 7 or 8 years. Then 2020 came along. All the Gen Z kids on TikTok started posting about their Crocs, and the management of Crocs really took advantage of that. They did all the right marketing moves. They bought a company where you could pin little things onto the shoes themselves, and it really just exploded in sales. So what I see happening right now, this is how I break down what's going on. The sales have exploded over the past year because of something that was considered to be a trend by investors. And what investors are doing is they're reading between the lines and they're saying, look, this massive amount of sales isn't going to continue. The company is going to have a big reversion to the mean where it was, 2019. And so we need to give it half the PE ratio it deserves. If this wasn't such an explosive last year, this company would probably have a 12 PE ratio. But we're going to price it at a 6.8 because we think this is going to go back down. The revenue is going to go back down. The margins of the company are going to compress, and it's no longer going to have this explosive growth. I think investors are smart to be thinking that way ahead of time, but I think that investors on the street may be overshooting how much the sales will compress. The EBIT has also expanded rapidly over the past year. The free cash flow as well has expanded rapidly over the past year. This is a very free cash flow generative company. Very free cash flow. And it will continue to generate more and more free cash flow in the future, especially after their acquisition of HeyDude, which they purchased another free cash flow company. So these companies together are producing real money that they can choose what to do with. Reinvest in their distribution centers, accumulate more brands, do share buybacks, pay a dividend. They have lots of things that they can do with this cash flow. The net income has also gone up over time. We can look at that here. The net income exploded in 2020 and 2021, like we've seen with all the other metrics. The same thing with the earnings per share. It exploded in 2020 and even further in 2021. Here's where we get to a part that's concerning if you're an investor in a company. If we filter by just the debt here, this is what it looks like. We have normal debt levels, then the debt goes up from $920 million to $3 billion. So the debt roughly tripled in 1 year. The reason for this debt is the acquisition of HeyDude. They decided to fund it mostly by debt without much stock. So most of this was in cash. They took on a lot of debt, and I think that was the right decision because they considered their stock to be cheap. They didn't want to use that. They'd rather use cheap debt to buy the company. Now, they do have some cash on hand as well, $171 million, but the debt is something that investors consider concerning. I don't think this is that concerning. They generate hundreds of millions of dollars of free cash flow on top of their debt payments every single quarter, and the HeyDude acquisition will account for the amount of debt they took on. They're generating more free cash flow because of that acquisition. The company doesn't pay a dividend, so no dividend history whatsoever, but they do have a history of doing share buybacks. If we look right here on the shares outstanding, we can see the long-term trends of their shares outstanding, and you can see that in recent years, the shares outstanding have been going down. It went up a little bit because they did that HeyDude acquisition, but that's not a huge leap in share count. Over time, they're going to be doing two things with their free cash flow: share buybacks, reducing the amount of debt. That's the things they're doing with their cash flow, on top of reinvesting back in their business. So I guess three things. They'll be paying down their debt, reinvesting in their business, and doing share buybacks. So overall, taking a glance at these fundamentals, it does check a lot of the boxes. We see a company growing revenues, growing EBITDA, net income. We see a company that's very free cash flow generative, especially compared to the size of the market cap. Then we also see a company that does share buybacks. They're committed to returning cash back to the shareholder. The debt is an issue if you're not looking at it through the lens of them acquiring a big free cash flow positive company, which is HeyDude. So I look at this fundamentals and I disagree with the market and the extent that the street is discounting this company. They're saying it needs to be priced at a 6 to 8 PE ratio because it is going to revert back to the mean to that extent. I think is unlikely. And even if it happens, this company is priced in a huge reversion to the mean. It is priced in a recession. It's priced in that Crocs is nothing but a trend, that it's going to die down in the next year. That's what's being priced into the stock. If that doesn't come to fruition, if the company continues to grow like they're projecting, then I think this could be a double, a company that goes up 2x in price. If we look at the actual analyst expectations, this year they're expected to grow their EPS by 24%, even above the explosive 2021. There's not many companies even expecting to grow their earnings in 2022. Most of them are having flat earnings. They're going down in earnings. Crocs is expected to grow their earnings by 24% and their revenue by 50%. So they're still expecting explosive growth year over year from 2021 to 2022. Some of this is because of the Hey Dude acquisition, but it is growth nonetheless. It will show up on the charts. It will show up in the valuation of the company. And I think this company will continue to grow beyond what is being priced into the stock. Right now, the stock is being priced for one outcome, and I think another outcome is going to happen. To give you an idea of where the PE sits right now compared to historical norms, this is what it looks like since 2006. This blue line on this chart here is the forward PE ratio of Crocs. It's gone down a couple times to where it is currently at a 7 forward PE. You can look at this right here, and just a month ago, that was a good time to buy it. If you bought in the peak fair a month ago, you got it at a 5 PE, you're already up 40%. So investors in this company just in the past month have done well. But regardless, that's one of the low points in the company. The 4 PE just a month ago. The other time was during March of 2020, during the COVID sell-off. Investors panic sold out of everything. So that's another time you could have bought it for this price. And then the third and final time since 2006 you could have bought it for its current price was back in 2008. In 2009, I actually believe. In February of 2009, when the stock market hit its ultimate bottom, when we were going into a massive recession, when the financial system was going down, when people were losing their homes, of course, this stock went down a lot. It went down to a 4 forward PE ratio. Now, other than that, look at where this company trades. On average, maybe around a 12 to 16. It's gone even as high as a 55 at one point during its peak. But on average, the company trades somewhere around a 12. I'd say that's pretty normal for this company. If this stock went from a 6.8, what it sits at right now, back to a normalized 12 forward PE ratio, that's about a 75% increase in stock price. Just to get to a 12. We don't have to go to a 15 or even a normal 17 PE ratio in line with the S&P 500 just to get to where it is at Skechers level. The same PE as Skechers, that's a 76% gain from here. That's what I'm looking at with the company. The potential downside is it could drop 50%. That could happen anytime. And if you're investing in a company like that, have it noted, this is a highly volatile, highly, it trades up and down every day, 5, 10% sometimes. It's very volatile, so it could drop 30%. That's not out of the question. But I think right now, there's more upside than downside. I think the bet is asymmetrical. Here's some other things I want to mention on this company. This is a table that summarizes the qualities that Peter Lynch looked for in what he considered to be the perfect stocks. This is Peter Lynch, the greatest stock picker of all time. I literally think he's a better stock picker than Warren Buffett. Warren Buffett had a different philosophy using leverage and float from insurance companies. Peter Lynch picked stocks that went up 10 times in price, and he did it repeatedly. He had numerous successes. He picked Taco Bell that went up 7 times. He picked Dunkin' Donuts that went up 10 times plus. Home Depot, 10 times. He knew how to get stocks that went up 10 times. And this is a list of the things that he looked for. The perfect stock he considered to be one that has a dull name, a dull business. Not the most exciting stocks in the exciting industries. He liked spinoffs. He liked companies that were even repulsive, disgusting companies, funeral companies, tobacco companies, ones that people didn't like going into. A depressing business was also something he looked for. See, the opposite of companies that people get excited about. Those are the type of companies that he liked to invest in. Niches and moats, habit-forming purchases, where costs benefit from tech. There's insiders buying the company, which Crocs has a ton of insiders that bought the company last month. They're already up 40%. They had no reason to buy the company other than they think the stock was going to go up. So Crocs does have the insiders buying. The next one was no institutional ownership. He liked having companies that weren't widely covered by Wall Street. The less analysts covering it, the more chance you have for alpha. Then low industry growth and no competition. This is one where I think Crocs checks half this box. It's definitely in an industry that has very low growth. The clothing industry and shoes is not a fast-growing industry. Not SaaS companies, not cloud computing, not cyber security. It's shoes. It's a low-growth industry that doesn't attract a lot of attention, and Crocs is a fast-growing company expected to grow revenue by 50% this year. And then you have false negative rumors. I don't think there's much of that about Crocs. The next thing he looked for is buybacks, which Crocs certainly does that. So when I look at the perfect stock, Crocs doesn't check every single box, but it checks a lot of them. It is a dull company in a dull industry that's growing really fast in a low growth industry. They have insiders buying it like crazy. It has a nice little niche. It has this brand recognition on social media, and it does have buybacks. They're doing a lot of buybacks as well with their enormous amount of free cash flow. Here's the stocks to avoid. The stocks that are the hottest ones on social media that garner all the clicks, that are the most exciting companies in the most exciting industries. Those are ones that you probably should avoid because they're typically overpriced. The next great Amazon stock. There's no chance of Crocs becoming the next Amazon. And when people talk about this company becoming the next Amazon, it's not. It's not going to become the next Amazon. Let me just answer that question for you right now. There is no next Amazon. Amazon is Amazon. There's not going to be the next one. The Whisper stock, the great story. These are the companies that are overly complex. People talk about them revolutionizing the world. You have to learn about their great secrets and success. These type of stocks you can hold off on until the actual story comes to fruition, until it actually starts making money. Avoid these stocks while they're still Whisper stocks. Diversification is a term used for diversification just for the sake of diversification. Even when you're buying stuff that doesn't add to the bottom line, it doesn't have any type of synergy with the company. I think that the acquisition of HeyDude does add synergy to the company. I think they'll use their back end and their sales and cross-marketing to promote both shoes to both customers. Then companies that have one large customer that makes up for a huge portion of their sales, that's never a quality that you want to see in a stock. That was like Twilio with Uber. Once Uber left them, that was 20% of their revenue gone. Then companies that have exciting names. Exciting names excites investors, attracts lots of capital. You want a company with a boring name that has actual fundamentals moving in the right direction. So basically, when I look over the bull case of Crocs, I can outline it this way. It is a dull company. There's not lots of attention drawn to it. If you search Crocs Analysis, there's like 2 videos on YouTube. Not many people are covering this company. And it's a fast-growing company in a slow-growing industry. If you have a fast-growing company in a fast-growing industry, that's just par for the course. If you have a fast-growing SaaS company, it doesn't really have anything unique. And then you have the problem, if the growth slows down, it just looks worse than its peers. Crocs is a fast-growing company in a slow-growing industry. That makes it unique to its peers. It's growing much faster than Lululemon or Nike or Skechers, much faster than any of its competition. And that's expected to continue throughout all of this year. It has strong brand recognition. You might not believe this, but Crocs does have brand value. They increased their prices by 18% year over year, while their sales in units actually increased. So if you can increase prices by 18% in 1 year and not lose customers, that is proving you have pricing power. There are knockoffs. There's many competitors that build little, mimics of Crocs, little knockoffs. But when people buy Crocs, they actually want to own the originals. They're higher quality. They have the form factor. They have everything correct. The knockoffs are never quite the same. It is at an extremely low valuation, an extremely low PE ratio that already has a lot of worries and concerns baked into the price. It has high free cash flow generation. This company has an 8.6% free cash flow yield. It's far superior to any other clothing company, and that free cash flow is expected to grow in the future. It will actually continue to grow. The price reflects a recession and consumer slowdown in spending and a reversion to the mean and margin contraction in the company. The price already reflects a lot of that. If that happens to a greater extent than what's already priced in, the stock could obviously go down. If everybody just moves on from Crocs and it was a 15 minutes of fame thing, then the price will go down. But the point I'm making here is a lot of this stuff is already priced in. When I look at the actual bear case of this company, there's a couple of things that I could outline as the most compelling arguments. One, I think, is the trend. Crocs is a trend item that had explosive growth in 2021. That's carrying over the 2022, but that trend could die down and maybe sales will totally decelerate and even go negative year over year. And if that happens, investors could become pessimistic on the stock, sell out, and the price goes down. That is one of the, I think, the most valid bear cases for the company. The other one is knockoff products. I think that one is, in my opinion, it's kind of a weak bear case. I don't think many people want to own knockoffs of Crocs. The other one I would say is there's no synergy with the Hey Dude acquisition. They just bought a different company. It's diversification. They can't grow sales with Hey Dude. I don't think that's going to be the case. Management's very optimistic about their ability to grow sales with this new product. They already have a very good fill of distribution, and they're trying to get it into more stores, more Walmarts, more locations all across the globe, international. And so I do think there's going to be synergy, but if that doesn't work out, if it's just diversification, if they just buy another company for the sake of buying it, that could hurt their overall returns. So there you have the bull case and bear case of the company. Now I want to go over position sizing and how I include this in my portfolio. I currently just own $2,000 of it. So it is a small position, around 2% of the portfolio. And I'm going to keep it there until earnings on the 4th. So they report earnings in just a couple of days. If it drops down because there's some concern that I think is temporary in the earnings, I'll add to the position. If it rockets up after the earnings, I'll just hold on to it. So either way, I feel good about buying a little bit of it right now and just holding on. And I'm not going to size this position as a large position comparative to Microsoft, Netflix, Google, or Amazon. This is going to be a smaller position because it's a more risky company. It doesn't have the same moat and the same, I think, long-term growth prospect over the next 10 years as the rest of the companies in my portfolio. The way that I look at this company is I'm sizing it as a smaller bet where I think I have the opportunity to make 2x my money at a minimum, I think 50% plus. And when I get to that point, I might look at taking gains. So for me, this is just a smaller position. I'm going to follow the story, but I think there's more upside right now than downside to a large extent. So there I am. I'm officially a proud Crocs stock owner, something that I didn't think I'd be saying anytime soon. But I hope you enjoyed the video. Let me know what you think. And as always, this is not investing advice. I would say to not buy this company unless you've done your own due diligence and research. Realize that these type of companies are incredibly volatile, highly risky. You can lose money. So with that said, that's all for now. I hope you enjoyed the episode. I'll see you in the next one.